Welcome to the Fair Value Pro series of instructional videos covering the topic of fair value as defined in the International Financial Reporting Standards IAS 16 Property, Plant and Equipment. My name is David Edgerton from APV Valuers and Asset Management, and I will be presenting this series of presentations. Some countries have their own localised versions of IAS 16, but the key concepts and requirements are essentially the same. This presentation provides an overview of the key requirements. Greater detail about some of the key concepts and the practical aspects of its implementation are included in a range of supporting presentations, which can also be found on the Fair Value Pro website. IAS 16, Property, Plant and Equipment, deals with non-current physical assets such as land, buildings, roads, water, sewerage and marine infrastructure, parks and other recreational assets, etc. Fair value is defined under paragraph 6 of the standard as being the amount for which an asset could be exchanged between knowledgeable, willing parties in an arm's length transaction. A bit of a mouthful, but relatively easy in concept. It is very easy to apply for assets that you can freely buy and sell. However, it becomes a little more complex when the assets are not freely traded. The standard provides for three methods that can be used to determine the fair value: market value, the income approach, or depreciated current replacement cost. The trick, of course, is knowing which one to apply and how to apply it. Market value is only to be applied when there is an active and liquid market. This means when there is an active market of willing buyers and sellers. In this situation, the valuer is able to determine market value by referencing the asset against the same or similar assets which have recently been sold. Examples include freehold land, but this must be done by a registered valuer with RICS or equivalent qualifications, residential type properties, motor vehicles, computers, plant and equipment, etc. These types of assets are openly traded in an efficient market. The income approach is commonly referred to as net present value, NPV, or discounted cash flow, DCF approach. It is used when the asset's value is primarily dependent on its revenue generating capability. In simple terms, if it fails to generate more income than expenditure, it is worthless. The more revenue it can generate, the more valuable it is. This method is usually used to value commercial and investment properties and the assets of commercial business units that are deemed to be for-profit entities under the International Financial Reporting Standards. Sometimes this includes public sector entities, but only if the business would be closed if it could not generate profit. The third approach is, of course, the depreciated current replacement cost approach. This method is a catch-all for all those assets not already covered by market value or income approach. It is also the method used most widely in the public and not-for-profit sectors. This is because their assets are acquired to provide services to the community at a cost, rather than to produce revenue. They provide future economic benefit via the provision of services that meet the community's needs. As a consequence, the basis of valuation changes from what you could sell the asset for, market value, to what it would cost me to acquire such an asset, the replacement cost. The following slides relate to the determination of fair value using the depreciated current replacement cost approach. This may sound a little strange, but one of the biggest mistakes made with determining fair value using the depreciated current replacement cost approach is focusing on the formula rather than the objective. The objective, of course, is to value the level of remaining service potential based on current replacement costs. From a terminology perspective, fair value equals the depreciated current replacement cost, which also equals the written down value at the time of valuation. The first step is to determine the gross current replacement cost. This will be based on whether you will replace the asset or not, and if so, whether you would reproduce it based on current design or replace it with a modern equivalent. If you would replace it with a modern equivalent, you also need to adjust for any differences in the service potential of the existing asset and the modern equivalent. Having done that, you then need to determine the amount of service potential that has been consumed, which is referred to as the accumulated depreciation. The balance remaining is the depreciated current replacement cost. This may also be referred to as the written down value or fair value. Clearly, because of the need to determine the amount of accumulated depreciation, the application of a fully compliant depreciation methodology is critical to ensuring the resulting fair value and depreciation expense calculations are materially correct. The use of overly simplistic approaches and key assumptions often lead to errors in excess of 60%. Within the definitions, there are three key aspects which require some consideration. Depreciation is the systematic allocation of the depreciable amount over the useful life. This means that the process must be logical and based on some form of systematic approach. The residual value is defined in terms of the amount the entity would obtain from the disposal of the asset at the end of its useful life. The useful life is limited to the period in which the asset is expected to be available for use, or defined by the number of production units. These definitions are extremely important, but unfortunately often misunderstood, especially with respect to assets which have their life continually extended beyond the original design life via renewal or cyclical maintenance. The other key aspects are that each component must be depreciated separately. The use of a weighted average estimate based on intuitive or simplistic assumptions does not satisfy the requirements of IAS 16. These simplistic approaches also fail to support the organisation's asset management framework. The depreciable amount needs to be depreciated over its useful life. Finally, and probably the most important requirement, is that the method of depreciation must match the pattern of consumption. In the mid-1990s, the various accounting standards around the world used to say that you should match the pattern of consumption, and if you couldn't, just apply a straight line. However, this was changed to shall, meaning must, and any reference of using straight line as a default was removed. The following diagram provides a simplistic view of the concepts, and usually is the way the concepts are taught at school and university. Firstly, the gross current replacement cost of the asset is determined. Consideration is then given to how long the asset will be of use to the entity and what the potential proceeds from disposal will be at that time. This defines both useful life and residual value. The difference between the gross current replacement cost and the residual value is by definition the depreciable amount, which is the portion that needs to be depreciated over the useful life. This needs to be done using a method that matches the pattern of consumption. For the purposes of this presentation, we have assumed the pattern is constant, so we would apply a straight line to the calculation. When the time comes to do a valuation, an assessment is made of the level of the remaining service potential. This then provides the depreciated current replacement cost, written down value, or fair value. The reality, however, for many entities, and in particular public sector entities, is that the assets are not written off or sold at the end of the period they are available for use, i.e. the useful life. Instead, they tend to be renewed or re-lifed. A good example is resealing a road surface and doing so well before the seal reaches the end of its design life. This approach to asset management is often referred to as cyclical maintenance, and effectively results in the asset life cycle being continually extended via capital expenditure. IAS 16 deals with subsequent expenditure and defines any expenditure that extends the life or increases the service potential as being capital in nature. Let's just now have a look at these concepts as they relate to cyclical maintenance assets. We will shorten the timescale so that we can see the full asset life cycle. Once the asset reaches the point where it is no longer available for use, i.e. the end of the useful life, the entity has a choice. It can either write the asset off or renew it through capital expenditure. Once the renewal is completed, the old asset has essentially been disposed of and a new asset with new useful life created. Following the process, the asset may experience a number of renewal cycles, each with its own useful life. The residual value existing in the old asset, however, has not been disposed, but instead has been transferred from the old asset into the new asset. In layman's terms, the entity has obtained value from the old asset equal to the residual value, and this value has been invested in the new asset. A quick summary on fair value. There are three approaches to determine fair value. If there is an active and liquid market, you use the market value approach. If there is any other market evidence, use either the market selling price, or if the asset's value is primarily dependent on its income generating capability, use the income approach. Finally, if none of the market value approaches are appropriate, then you must use the depreciated current replacement cost approach. To determine depreciated current replacement cost, the steps are: first, decide whether replacement would occur either by reproduction or via a modern equivalent. This step is critical to determining the gross current replacement cost. Identify all of the costs of the asset. Further guidance can be obtained from the decision trees available from the Fair Value Pro website. The asset then needs to be split into its various components. The gross current replacement cost then needs to be determined for each component, taking into account any differences in the service potential of the existing asset and the replacement asset. The written down value needs to be calculated for each component using a fully compliant depreciation methodology. Finally, the various component figures need to be added together to provide the fair value for the entire asset. I hope this brief introduction to fair value has been useful. Fair Value Pro is the world's leading software specifically designed to enable entities to take control over the fair value process. It makes the IFRS valuations simple. The Fair Value Pro website includes a range of other educational materials. We also welcome questions and comments via the Fair Value forum on the Fair Value Pro website. You can also contact me directly on info@fairvaluepro.com if you have any questions of either Fair Value or Fair Value Pro.